Good morning. It's great to be here out west. It's a little bit harder to get here from Cal Poly, it seems, than it is from Chicago. My trip was shorter, so that's kind of interesting how modern technology makes it so easy to hop over here and enjoy some of your good California weather and food last night. And so it's really great to experience the hospitality of Cal Poly. I appreciate their offer, and also the farm credit organizations here that are sponsors. Thank you for your efforts as well. So I kind of figured that I needed to do something a little different than just talk about California's land prices, because I'm really not an expert in that area. I know that one of the sayings is always about real estate, it's local, local, local. And obviously in California that's maybe more true than almost anywhere else in the country because of all the variety of crops you have here and the different kinds of agricultural enterprises, as well as the various urban settings and the various influences between rural and urban amenities in particular. So there's a lot of different things going on in California, and I'll try to elucidate those by giving a contrast with what's happening in the Midwest, and you'll see some very common strands that help us understand the phenomenon that is land values and how they rise in various ways and what some of the different factors are. And to set that up, I wanted to highlight a little bit about where we are in the country, because the United States is a very diverse country, and in some senses the heartland of agriculture is the Midwest, but then also that fruitful rim that the United States Department of Agriculture talks about, which includes, of course, California and Florida, which are maybe the two other key areas in the United States agriculture. So when you think about the Midwest, we have the Corn Belt, that really the 7th Federal Reserve District. Here you can see out of Chicago, that area, that 5-state region is what we consider our main focus, but at the same time I want to cover agriculture over the entire country as well. So you can't just look at the sector in isolation. But the California district is much different. If you think about Illinois versus California in terms of their farmland profiles, you can see that the share of total land is very different. In California, there's a whole lot of other land that's not related to farmland, whether it's owned by the national government or state and local. So only 25% is the share of agricultural land. And in Illinois, it's 75%. So there's a big difference there, even though the total acres are pretty much roughly the same in terms of the ag land available. The state of California is much larger. The average size of the farms isn't that much different. It's a little over 300 acres in California, about 350 acres in Illinois. But where you start to see more difference is the percent of farms that are small, under 100 acres. Over 75% are in California, about 50% in Illinois. And then cropland, 37% share in California, 88% in Illinois. Irrigated cropland, 77% of is what's irrigated here, only 2% in Illinois. And then pasture is about half here and only 3% in Illinois. So definitely some hints just in the kinds of farmland, and that there are very different profiles for agriculture between these states. At the same time, if you look at this map of the United States broken out by the size of farms, if you have a farm that's selling over $250,000 of product in 2007, then you're going to be the very darkest regions. So only over 25% of those farms are the large category farms. And then the very lightest shade are the ones where they have fewest. And you can see that if you're thinking about Illinois, the heart of the Corn Belt here, it's very intense, large agriculture. You look at California, and much of California, it's very intense, large agriculture. So that's a similarity between the regions. At the same time, when you think about the crops, it's quite a bit different. You have a lot more diversification in California with high-value products, as we've just been hearing about, and the top 10 commodities generated about 2/3 of the state total. Whereas in Illinois, it's much more focused on corn and soybean production. In the 7th District now, combining the 5-state region around Illinois, the top 10 commodities generated 93% of the total value. So there's much more shift towards the top in terms of the total output for agriculture. In California, there's some crops that the United States depends entirely on, such as the value of the almonds and pistachios and walnuts. Very high percentage of U.S. output in grapes and strawberries and lettuce as well. But then you think about the Midwest, and we produce some things like cranberries, over 59% of cranberries, 13% of the sugar beets in Michigan. So there are a few products that are unique within the Midwest, but nothing like California. And then if you look at the output shares, as a percent of the U.S., you can see that corn, soybeans, and hogs are really the bread and butter, so to speak, of the Midwest, with dairy being pretty important, especially in Wisconsin, with over 20% of the U.S. output. Whereas in California, dairy's roughly the same. When you look at cattle, it's pretty similar. But then you start to see, California's predominance come forward in things like nursery and garden and hay. It's higher. And then tomatoes and, of course, all those other unique products that we already mentioned, including the nuts, are there. That's where California really starts to gain its cash receipt growth. And the next chart kind of summarizes this by looking at the top 10 products only, and there's 3 that are that are the same between the regions, but you can see corn, soybeans, and hogs are, dominating in the Midwest, and then dairy comes and cattle, and so those are larger than what you have here in California, but at the same time, greenhouse and nursery is, about half less than half the size of what you produce here in California. So that's the one that's in common that California dominates on. But then there's just so many products that are still over $1 billion in cash receipts, whereas if you look on the right, as soon as you get past nurseries and greenhouses, then you're getting down into less than 500 million cash receipts. So it's definitely a big drop-off quickly, and the distribution between the two sides is very different. But then this kind of leads into the question, why is there so much interest in farmland values? When you think about risk management and how that fits into an operation, certainly as lenders, one of the biggest inputs is the sector value is agricultural land, over 75%, and with the run-ups in recent years, probably over 80%. So definitely there's been a major focus on this, just because it is one of the biggest inputs into agriculture assets. And when you think about the health of agriculture, it's kind of a barometer. If you're trying to keep your pulse, your finger on the pulse of agriculture, land values really are one of the ways to do that. And it certainly links into collateral values and portfolio quality, and it just makes it a whole lot easier to understand what's going on if you are following the land values. And just in coffee houses, that's one of the things people talk about. So the impact on the lending institutions is one of the reasons our bank is very interested in this, because we have a lot of small rural banks that really are involved with agriculture still. And you even have some of the bigger ones like Wells that have a very large agricultural portfolio in size, not necessarily as a percent of their assets. But then, of course, behind all of this, in the back of our minds, is the 1980 farm crisis that occurred in the Midwest. And that was very wrenching and very real to people in our district, and it didn't hit California maybe as hard in some ways, but overall, the farm crisis is still what we're thinking about, especially in terms of credit and the impact it could have on the future. So that's one reason why we follow this and produce the Ag Letter, and that data comes out quarterly. But this data we're looking at right now in the chart for the California farmland values is from the USDA. They do an annual survey of farmland values that gives a lot more breakdown, a lot more information in terms of dollar amounts than what we can provide in our survey of bankers. And so it really highlights where the most valuable land is in terms of the kind that in California. It's that irrigated cropland, which brings us back to the water discussion, that the land there has gone up dramatically, over $12,000 an acre at one point, but then it's eased off after 2008. And one way to see the influence of that is just to look at the difference between the average cropland, which is this black line in here. This is the average, and it's much higher than the non-irrigated. So you can see the pull of the irrigated cropland is really pretty strong there. And then, of course, pasture land is the lowest level there in terms of the ag land values, but it's still, of course, a very important component, especially when you think about the dairy industry. So when you're looking at that trend, it seems like there was a huge increase there during the 2003, 2004, 2005 into 2007, but we have a question, kind of what happened after that. And so I think I have some insight into that, but there's probably some specific market-related issues as well, and we'll look at that in a little bit. So now let's transition into thinking about the U.S. land values, and here I've done something that we call adjusting for inflation, so these are real in terms of the dollar value. So $2010, so we're trying to take away the role of inflation and see the underlying factors. And here you can see once again that California land values peaked in 2008 and have come down a little bit. And that's in contrast to what's happened most recently in our district, where land values have kept rising quite fast and increased over 20% last year. But one of the things that you can't really see from this data right now is that there's a little bit of a lag in the USDA data takes the number for that year at the very start of the year, and then they report that in August. So for 2011, the number really is at the end of 2010, and for 2012, we'll get that number in August, and that'll be as of January 1st. So it's not quite as, doesn't pick up the most recent trends necessarily, but it's a good barometer for long term. And if you look back in time, you can see how the peak for California and the U.S. was relatively close. Around 1980 was when at one time there was a peak, and then both declined, but the Midwest land values dropped much more steeply and longer. Well, I guess not really longer, about the same amount. And then there was a long period of time of not so rapid growth, but then both have experienced relative accelerations within the last decade. And before the slowdown after 2007, when we had the recession in the United States, then there was some slowness here for the U.S. total as well, and now some pickup again, even though we haven't seen that yet in California. When we look at the changes each year, here you can see how California and the 7th District varied, and you can see how the drops were much steeper in the 7th District during the 1980s farm crisis, and then California had been growing faster here in a number of years, and especially here, that spike up, I wasn't able to explain fully in my mind, but I think one of the key factors when you're thinking about what was happening during that period was that urbanization and the housing boom were at their ultimate during that time. And so there certainly In California, from what I understand, was a lot further into that than the Midwest in terms of getting to the peak of the housing bubble. And we'll examine that a little more carefully in a bit. So current agricultural land trends are, interesting in terms of some of their implications for where we're headed, but I took a lot of my information from the California chapter of the Rural Appraisers and Farm Managers Association. They do an annual survey, and they published that in this springtime, and it gave a lot of great information about what's going on in California and Nevada. And so by kind of reading through the different regions, in general, I know there's, some differences from place to place, but it seemed that we have stable to increasing land values in California since the USDA's last number came out a year ago almost now. And so, there were some exceptions, and places like dairy and rural residential parcels were mainly where those were, but some housing, is one of the factors that's still recovering, and that's something that has impacted those in the rural residential parcels particularly. And there definitely is a premium for access to water in California that we don't see in the Midwest, and at the same time, there was demand for nut orchards, and that seemed to be higher, due to the higher nut prices that have come, a lot of it from exporting products. So definitely some more positive trends than what maybe the previous chart seemed to indicate. At the same time, in the Midwest, we've seen much bigger increases, rapid rises in the last 3-4 years, primarily because farmers are buying farmland. They have an attraction to it. The premium for cropland is, the premium for cropland is very in demand as farmers want to expand operations and have ability to grow more corn and soybeans, to be able to pass the farm on to a next generation and plan for the future. At the same time, recreational ground has been showing evidence of a market bottom. It's been a little tougher in terms of, pieces of ground that aren't as amenable to farming in terms of row crops. And so, ground that has some woods and some streams, those had been very popular back, a decade ago. And then after the recession, a lot of that demand kind of went away. There weren't as many people coming down from Chicago and wanting to hunt in central Illinois. So that was one of the factors that had been, slowing down some of those kinds of parcels. And now it seems that there's been some, bottoming in that kind of land market. So what are some of the factors that affect farmland values? I guess the key thing is to think about expected net returns. What is that ground going to bring back to the farm operation? And the investor is looking at the same kind of issue. So that's interrelated with interest rates and government programs, capital investment and structures, and non-farm demand are kind of that next category. And the non-farm demand obviously has been one of the key things in terms of urbanization and where people are wanting to live. And so we'll examine that a little more carefully, but there are a whole lot of other issues. It's a very complex dynamic, and here you can see that we have inflation, we have lending policies, we have other investments, speculative nature of investments, technology, trade, site characteristics, environmental issues, water, and in California you get into things more like degree days, that are very important for certain kinds of crops. And then, of course, soils are undergirding a lot of the different characteristics as well. So getting back to that whole issue of urbanization and its relationship with demand for farmland, I think that the USDA has done some nice work in looking at factors like population growth and the adjacency to metropolitan areas. And this chart brings it together with showing on the bottom a natural amenity scale. So as you move towards the left, you have lower levels of amenities, As you move towards the right, you have higher levels of amenities, maybe lakes, maybe other kinds of recreational opportunities. And so they have tried to classify around the country the different features that draw people to regions and really attract people. And those lead to higher population growth, as you would expect. And then between the lighter green and the darker green, it gives you a clue as whether they're adjacent to a metropolitan area or not. And if you have growth in the higher amenity region, you have much higher growth if you're close to a metropolitan area, because obviously the people in the metropolitan area can take advantage of getting to your area quickly, and you have a lot more opportunity for income from that recreational revenue, which is one of the things that is helping to expand farm operations and to give new life to some kinds of farming that have been slower growth and had been falling behind. But we certainly have a lot of corn mazes and those kinds of things that are starting to generate revenue on farms close to urban areas. So what you can see from this is that we do see a growth in terms of the population change, and that is going to factor in as well, that there's that demand for land that's on the fringe of these urban areas, and farmland closer to them is going to be influenced. When you think about the housing markets, you can see we've had some pretty traumatic times, and California has been at the forefront of some of that. If you think about, we peaked out over at, in housing starts over 2,000 units a month there, and then it just tanked, going down, under a million there, and about a $1.5 million drop, or a 1.5 drop there. And certainly, we've been kind of moving around that bottom for a few years, and the recession has ended. If you think about the recession, that's this kind of shaded area. So the recession ended about 3 years ago, but the housing markets hadn't recovered at all until more recently, and just in the last year there's been some movement upwards, so that's been a positive. But you think about what's happened with interest rates on home loans. They've been down at record low levels, so they're very low. At the same time, there just hasn't been the normal market mechanism to transmit that incentive to borrow in terms of housing starts, and it's been a lot of different factors. Part of it is that banks and institutions that normally would have been able to lend to people haven't. They've had much tighter standards. They've had to rebuild their balance sheets, so the financial crisis has hit and has been extending the housing depression. And of course, you had the foreclosure issues, and this chart shows kind of how California was impacted so dramatically. When you look at the areas with the highest level of foreclosure rates, they're the red. The pink are almost as bad, but you think about where the worst hit regions was the west and the southeast. But then if you look at what happened around Chicago, we didn't miss out on the bad times. We ended up having a lot of foreclosures out on the collar counties in particular around the Chicago area, where there was a lot of rapid expansion from 2000 to 2005, and then they just hit a wall, and a lot of those properties were put off of the market for development. They've been targeted for development, and now a lot of them are back in farming. In one particular example that there is, we had a farmer that sold his land for $40,000 an acre, not too far away from Chicago, and about 3 years later he bought it back at $10,000 an acre. So that particular individual did pretty well in getting through the ups and downs of the market, but not everyone fared so well, obviously. There are a lot of farmland deals that went bust, and so it's a positive for farming that it maintained. I guess one of the things that is interesting, if you look at the whole issue over the last decade, we really saw land values starting to rise in the 2004-2005 part of the time period in the Midwest. And one of the reasons for that was that there were 1031 exchange opportunities for farmers that were close to the metropolitan areas. They would sell their land for a lot to a developer, then they'd turn around and need to buy land, say, in central Illinois. And so that was pushing up farmland values kind of around the district as people needed to migrate within the region to find good farm ground. And they had a lot of money, so they could sell a smaller operation up close to Chicago and buy a bigger operation somewhere further south. So there was a lot of opportunity for that kind of exchanges and tax deferring the returns on that. But then around 2005, 2006, that started to go away. So that was one of the factors that you can see probably in these charts, that both in California and not so much in the Midwest, we had farmland prices start to slow down then. And I guess I don't have one for Illinois, but the bottom right is for Iowa. So you can see that it was kind of a similar phenomenon, I think, for Illinois at this point, that there was this farmland rural housing price line that would show on the right axis that there was increase, and then it topped out. When the urban influence stopped, it started dropping then and reverted. But then farmland has continued to appreciate for the most part. It's just that there's been a transfer from that rising housing sector to other farm income sector related factors that have led to continued increases. And here you can see some of them. If you think about the higher expected stream of earnings from farm income, that's been a very key one with higher corn and soybean prices, in particular in the Midwest, and productivity and yield increases. Both of those have led to increases in farmland values. But then we also have a bigger mix of investors. You have more diversifiers in terms of their investment portfolio. So there's been some more demand from outside of the agricultural sector. People, have decided, when you can't find a good, investment in, a CD, when you can't find a good investment in the stock markets, you think you're going to find something in agriculture where you have, pretty good returns and what seems to be less problems with, volatility. That's something that they've really been looking at, even though there have been fewer recreational buyers in the last 5 years, but more. There's definitely been some interest in income funds where people have bought land together and are able to then invest that way. Off-farm income growth is another supporting factor that has been varied. The recession hurt the income of a lot of the small farmers, and we'll look at that in a little more detail. Certainly government payments have been lower, but they were important at various times, and there's been the continued role of crop insurance that kind of undergirds the agricultural sector as well. But then one of the key factors has been low interest rates that agriculture has been facing, and that has helped to boost the capitalization rates that people are thinking, or they're willing to buy the land without having as high of returns. And so that has been one of the factors that has boosted land values as well. So limited availability is also a key, that we have just not that much farmland coming onto the market, although this last year there does seem to be some of that, some of the trusts and other kind of entities that are seeing, high farmland values are realizing this may be a time to put it on the market, and to, families that may no longer live in the Midwest even. They might live out in California but control land in the Midwest and may have decided now looks like a good time to sell. And of course, opportunism, as always, is something that can lead to farmland prices rising, just because there's opportunities that are seen and that can generate cash. So let's look at a couple of particular examples from California, and these again are from the trends in the publication out here from the farm managers and rural appraisers. Here you can see that Napa vineyards are the premium in the state, and the values of those per acre can be upwards of half or a quarter of $1,000,000, and so it's definitely a premium. And at the same time, there's been some increases in some of the other regions. If you look here, there's been some increases in recent years, Sonoma County, and so it's really interesting, from a Midwesterner's perspective, to look and see how there can be, a name can have such a big factor. In the Midwest, you don't really think about Iroquois County corn versus, Boone County corn or something like that. It's just very different when you have these kinds of land markets that are tied specifically to a name and a place, and that's a very interesting difference. And of course, that's why they're so valuable. It's a value-added product. It's not just a commodity product, and that's one of the things people in the Midwest are trying to change. Another important area is almonds, or I guess almonds, I probably should say. I met some people from out here, and they owned an orchard, and they kept talking about almonds, and I was like, almonds? I haven't never heard of almonds. What are almonds? And then I figured it out finally. I was like, oh. So you can see that the fruit or the nut trees, are growing in value. There have been, extensive exports to Asia, particularly China, and so that's something that is really helping to boost some of the revenues there. But once again, there's some big differences between different producing regions, and I am not an expert on those, but I anticipate that probably water and productivity are two of the factors that are big between those. And the value-added products really are a key, I think. If we look at where we're headed in agriculture, I like to use a dollar bill that the USDA has split up for us. About 16 cents of that dollar spent on food goes to the farm share. And most of the rest of that is all the different people in the marketing, the transportation and food production side. And so those, the farmers in California, I trust, get a much higher share of that than what we do in the Midwest. 16 cents seems low for California and maybe high for some of the Midwesterners. And when you think about what can be done to generate more value added for agriculture that gets back to the farmer or stays on the farm, things like, products like, grapes and almonds and others are, good ways to do that, but you can't really produce some of those products in the Midwest very well. But we have to be thinking about what products we can produce and what is value added. And so one of the areas that's been growing is organic production. Local foods is kind of, an associated kind of trend where you start growing things closer to you and having less shipping costs, but at the same time, there's a premium from people's interest in having something that they see as more in line with their food desires, so that consumerism once again comes into place. And you think about organics in the strict sense of, having no pesticides and doing things in various strict ways according to USDA, and those products have been growing very quickly as well. You can see that by over 21 billion by 2008, and the price premiums there have been very strong. In one of the areas that we've heard a lot about in the Midwest is dairy, and so you have milk getting a very large premium from organic production and for our farmers. And that's been saving some of the small Wisconsin dairy farmers that, they were getting pushed out of the business just because they couldn't modernize and have a large herd of cattle. But then they figured that they could band together and have some co-ops and do milk together, and that has helped to really keep some of them on the farm. But combining organic with direct sales is really important as well. If you think about, you can see this growth in organic in all the different areas, and but you have to be able to get it to the individual, and that's something that is important. And if you think about the size of organic agriculture in the Midwest, it's still a fraction of what you have here in California in terms of the size. You think about the number of certified operations, it doesn't seem that far apart, with almost 3,000 here in California and a little over 2,000 here in the Midwest. But then the number of acres and crops is quite significantly higher, and then the acre and rangeland and pasture land is quite a bit higher. So you ended up with not quite double the total acres, and even then it's only 3% of the state's farmland in California, and so it's still relatively small, so there's a lot of room to grow, and that's one reason the growth has been so rapid. But then in the Midwest, we really have been behind the ball in doing, farm value-added products sold directly to consumers, and whether it's farmers markets or consumer-supported agriculture with CSAs and getting local food to people, that's something that's been growing rapidly. But here you can see all the little dots show that there's a lot more here in California, and here in the Midwest we're still trying to expand that. Of course, the Northeast has a lot in this area as well. So definitely there are a lot of opportunities still to expand the income from selling directly to people, but that has been one of the factors, I think, that has helped to increase net farm income. And here you can see how that's been trending over the last few years, and it's definitely had a few peaks during this time. If you look at the 7th District, when corn prices went up and soybean prices were high, then you had a couple of these peaks here, and then they come back down, and now they've been heading up again. So the next iteration of this data should show higher numbers still again. And overall, there's been a rise in the amount of farm income that's been growing relative to the input costs. If you think about net farm income as a percent of the U.S., I didn't have a slide for this, but in 1950, California had about 6.2% of the net farm income for the United States. The 7th District had about 22%. And so then you think over time, California grew quite quickly, and even to 1980, it was 25% of the total net farm income that year. And in the Midwest, it dropped off to only 17% at that time. It was a tougher time, and so we saw the land values falling much faster for the Midwest as we had less income. And then even in 1983, that was a year where we had a loss for farming in the Midwest. If you think about the implications of that for farmland values, it was pretty severe, and that's when a lot of the operations just couldn't support their cash flows, went negative, so then they ended up having to sell farms. So the latest data from 2010 show that 13% of the net farm income in the United States was from California, and 19% was from the Midwest. So definitely, between California and the Midwest, there's a large portion of the profitable agricultural enterprises in that region. And when you think about the regional impact as well, that we think about not just the total, but then we can see the government's role in this. If you want to really get a California grower upset, probably you say something about that they deserve what they get in this regard, and they don't get much, do they? Here you can see the little additional dark part on the top is the government payments, and here in the Midwest, there's a lot of farmers that receive a lot of government payments, and out in California, there aren't many farms that get government payments. So it's really one of those matters that the regional disparity has helped to drive what's happening in the current Farm Bill, and there was some attempts to make things a little more fair in that regard in the previous Farm Bill, but we're still mired in politics that has one region and one crop working against the other, and so that lobbying that was mentioned in the previous presentation is continuing to go on all the time, and it's getting pretty hard in Washington to see how we're going to come up with a reasonable policy after all the lobbying and all the current politics this year. It's hard to tell what we'll end up with, but definitely government payments have been one factor that have helped to increase farmland values. But we had a survey, a conference last year at the Chicago Federal Reserve Bank that I summarized in what's called the Chicago Fed Letter, and it was talking about rising farmland values, causes and cautions. And one of the papers was talking about that really farmland values have not gained as much in the Midwest in the last 5 years or so from government payments, and you can see that in the previous slide that there were smaller government payments during that time. But prior to that, there definitely had been a statistical significance to those payments that were boosting farmland values. If you think about the increases in farmland values as well, you can think about the incomes growing. The USDA numbers show how much of the income comes from off the farm. This yellow is the off-farm income for farm households. And farm households now are more affluent than the U.S. nation as a whole on average. And at the same time, the amount that they get from agriculture is this green part. So agriculture has been providing more funds in the last decade for farm households, but at the same time, the vast majority still are from off the farm. But at the same time, when you think about what's been happening in terms of the different kinds of farm households, if you think about residential farms, here they actually lose some money on the farm, but they're supported by larger off-farm income. The middle farms, the intermediate, get basically nothing from the farm, and they don't have as much off-farm income. It's only when you get to the larger commercial farms that you really get to see where the farm income is coming from in the United States, and they even still have some from the off the farm as well. So that off-farm income is vital pretty much at every level of agriculture, and so that's an important factor when you're thinking about how the interlinkages are between farmland values and rural residences, as well as then the farm operator who wants to get insurance, and so his wife works in town, and maybe he's a school teacher, and so they have that insurance that can help them at the same time that they have the farm where there's a lot more variability in income years, and so they can buffer that to some extent, and so that can help to keep people on farms that maybe otherwise wouldn't. But the recession really had been hurting. I guess there's a long-term trend that non-metro incomes have been falling further behind their metro counterparts. But then the recession hit incomes in rural areas, and that was a slowdown in some of the link to farm values. But now we've had some returns from manufacturing has been on the rebound in rural areas. You can look at tractor and combine sales, that's one indicator, but there was increases in rural employment from manufacturing of 3%, and it's up, or 3.8% in 2011, and it's 14% up from 2009. And part of that was exports have spurred rural manufacturing. Here you can see some of the numbers there. And overall exports have been a big factor. I mentioned nut exports earlier, but when you look at the value of U.S. agricultural exports, they've been growing dramatically in the last 10 years, and there have been some ups and downs, but that's one of the sectors that has kept a strong trade balance for the U.S., has helped to promote lower the trade deficit by having a positive trade balance for agricultural products. So ag exports have boosted the incomes, and that's been helping to boost agricultural land values. But I wanted to just analyze a couple of things that look at some specific corn and soybean numbers. When you think about, I talked about higher corn and soybean prices, and maybe this chart doesn't make it look so, because this is the real crop prices when adjusted by inflation over time, and it's kind of been generally trending downward. But then the key thing for land values has been that even though we were down at this level of soybean prices of around $10 a bushel, corn prices, around $2.50 to $3 a bushel, then we've seen increases since that time, and those increases in the last 5 years have really helped to make crop production much more profitable. And one of the factors, as mentioned before, has been ethanol production, and that has boosted the prices for corn and soybeans. Not just because of ethanol, you make that from the corn, but then there's that trade-off. So farmers that need to grow soybeans also, if they could switch to corn, maybe and there was a lot of continuous corn operations in the Midwest, so the soybean prices were higher as well. But then there were world trade factors as well in there. So now we've hit a point where there really isn't a likelihood that the biofuels are going to lead to higher prices for corn and soybeans in the near future. The blend wall, so to speak, is being hit now, that corn ethanol has really reached its level at which it's going to max out, and it will maintain that level for a while into the future, but it's not going to grow like it has. So the impetus to future increases is really gone. But one area that could lead to some increases in the future still is the yields, that we can see those growing more and more. This year, the USDA expects the corn yield to be a record, 166 bushels per acre. And here you can see how we've had dramatic increases in corn yields in our district, and almost as dramatic increases in soybean yields in the last 50 years or so. And so it's really an amazing story that agriculture has been able to produce so much more. And it's not just in our district. Here you can see some of the USDA numbers for other states, and California has had some positive increases in productivity over time, though maybe lagging a little bit some of the other regions. But then overall as a nation, if you look at the data, our inputs really are about the same level they were back around 1950. A lot of that is changing the inputs from labor to mechanization, but at the same time, output has grown by over 2.5 times. And so it's really an amazing story that agriculture has to tell about what can be done with more, without producing as much. So it's a key story is the productivity of agriculture, helping to make the land worth more. It's not all happiness, though, in agriculture right now. If we think about hog and dairy, particularly, those are key for the Midwest. And there, the profitability has been down in the last, early part of this year. I mentioned that in the ag letter, that here, if you think about the input costs from corn and different feed, and then relate that to the price of the hogs and the milk, they're really getting down toward the low levels again in terms of these measures. So there is some slowing there possibly from that, lower income potential, and at this point it's a little uncertain. Now I'm going to give you some data from our own survey, and here you can see the banks that are part of our survey that spread across the Corn Belt there and up into Wisconsin and Michigan. And in our district, we've had over 20% increase last year, and very strong increases in most of the years of the last 10 decades. We had a little weakness a few years ago, but it really matches quite closely with the increases in land values that have occurred in the USDA numbers as well. So you can see how they track there. But one of the things that I wanted to highlight is that you think about the relationship of that land value and the land returns as represented by rental rates. Here you can see the rental rates increasing in nominal terms quite dramatically, and inflation-adjusted terms, the red line here, not quite as strongly. There was a period of time, 30-year period, where they really didn't increase a lot. But then now they've been increasing as land values have gone up quite a bit. But there's somewhat of a lag. It's not, it takes time for some of the contracts to be rediscussed and renegotiated, and a lot of times owners don't want to increase too quickly because they're, if they have a good operator, they want to keep that operator on the farm, and they have a relationship. So it's kind of an interesting dynamic that's going on. But one of the things that I have used our data for is to look at kind of a price to earnings ratio, where you take the price of the land value, and relate it to the earnings in index form here. And you can see that we've had, this index drifting up over time, that we've had higher and higher ratios of prices to the land values, or to the land rental rates. And there's various factors in that. Part of it is, urbanization factors probably as well, and development issues. But just generally, there's that lag. And so when you think about it in the reverse side, then you take the earnings and divide it by the price. And I compared that to the real returns on 10-year Treasury bonds. You can see one of those factors coming into play that we've mentioned a little bit, that was interest rates, and how interest rates have really been tracking where the farmland prices have gone. So as interest rates have been lower over the last couple decades, we've seen the farmland prices rising in reverse to that kind of, that the returns have been driven down in terms of the land values, and so that's been something that's been helping to move the land values higher. And getting back to USDA data now, and comparing with California in the 7th District, you can see kind of that same trend using a rent-to-value ratio, a very similar number, except here it's not put in an index form first. And so California has a higher overall rate, but at the same time in the last 15 years or so, it's been trending down pretty much in a similar fashion to the Midwest. And when you think about real changes in the values of cash rents, you can see that California has had some, this is just for irrigated cropland now for California. It's not all cropland. But there have been some big increases in values at times, but cash rents have kind of lagged, and then now there have been some decreases in cash rents, but they haven't generally been as large as those in the land values as well. Now, I want to kind of close here with a couple of thoughts about where the status of finances in agriculture are, because this is an important one, I think, for us to understand that, it's very different now than in the 1980s. And one of the ways you can show that is by comparing assets and equity versus debt in the agricultural sector. So USDA has a good data set for that, and you can see how assets and equity have been growing over the last decade, and debt has really stayed pretty much the same. It's a little bit higher, but hasn't changed too much. And so one of the key differences between now and the 1980s is that the debt-to-asset ratio is at a relatively low level now, whereas in the 1980s it had peaked. And you think about that period, you had, coming out of the 70s, we had high inflation. The Fed responded by raising interest rates in order to slow down the economy and to get inflation under control. And that really put the hammer on agriculture. You had, variable interest rates that went up. You had operations that couldn't cash flow. And so there was a major crisis in agriculture. And today, it's a very different situation. If you look at interest rates now for agriculture, this is from our survey in the Midwest, they peaked out in the early 1980s, and they've been trending down ever since. And when the cycles occur, they raise some, but then they keep on going down. So right now, they're at the lowest levels in our survey, and we have an anticipation that they're not going to rise very rapidly. If you think about what the Federal Open Market Committee does for monetary policy, here you can see that the anticipation is that we'll have 2 more years of low interest rates, and then they'll start to rise some, but not dramatically. And so that's the anticipation based on the releases of the Federal Open Market Committee for interest rates. So that's been a huge factor that's been driving farmland values up in the Midwest. Obviously, that hasn't been quite the same factor that has in California up to this point, but now it seems like maybe the housing markets have been healed enough in California that could start to be a bigger factor. And so when you think about the current value of farm real estate versus the maximum affordable value, the USDA has computed this, and you can see that at certain times the actual farm real estate, the blue line, has been much higher than what they would think would be the maximum affordable here, this dotted line. But in the last couple year or so, they've kind of joined together again to indicate that there probably is not an overexuberance in farmland values at the moment in terms of what's affordable for the sector. But you look back to the 1980s here, and there definitely was a period of time where it was very much out of alignment. Yeah.
What variables are you taking into account when you say current income and cash flow?
Well, I am using the data that the USDA put together on this, and I didn't look at it carefully enough to know exactly which numbers, but the farm income that they have generated would be, so this is looking at the U.S., so it's kind of on average. This is what would be the case. So, but they would take into account the current interest rate and things like that. So where do farmland values go next? That's a question that everybody wants to know. And once again, farmland is limited. There's not that much supply. It doesn't grow on trees. But the demand has been for farmers to want more. And so that's one reason we expect farmland values in the Midwest to continue to rise, though not quite as rapidly. But there's a lot more variable factors in other areas like California, where it seems like there's been some stabilization of farmland values and some increases in certain areas, but not everywhere. And so it is uncertain at how long the farmland boom's going to last. And at the same time, it definitely is a different dynamic than in the 1980s. And the fundamentals favor further increases, but it's really, I can't give you a date at when it'll end, but at some point it will. We just know that these cycles don't go on forever. So I hope that you found this helpful, and I would appreciate any questions, and I'll stick around and you can try to get a hold of me throughout the day. Thank you.
So do you see a bubble or not?
Oh, I didn't say the word bubble, did I? I stay away from that because I don't really see a bubble. There's certainly strong increases, and it's been something that if you looked from outside the industry, yes, it looks like a bubble. But really, I think the farm incomes have been higher, and farmers have come up with new ways to generate income, and so it really is not a bubble in the sense that it's been supported by the fundamentals. And so it could become one maybe, but at the same time, I don't think we're in a bubble right now.
Do you think that disparity in farmland value between California and the Midwest puts the California operator at a significant disadvantage when passing the farm operation on to the next generation?
Well, it definitely can be, I guess. I think that the farmers in the Midwest are now dealing with some of the same things because they have to have a lot more acres in order to be able to generate similar kinds of income that you can on smaller number of acres here. So probably it's not as significant a disadvantage just because of the different type of agriculture, but definitely across different kinds of farming there are going to be those particularities that make it tougher, and so hopefully the Congress will maintain rules and make it so that it's possible to keep generation after generation on the farm.
Thank you.
Exports are a huge part of values out here in California. I'm not an expert, know very little about it, but my perception is Europe is a complete basket case, and that export, I don't know how much longer we can count on exports to Europe, or if we send stuff over there, can we get paid for it? Is that factoring in to your analysis in any way?
Well, to some slight extent that the uncertainties are there, and it's definitely a concern. But I think for most of the growth that we've seen in U.S. agricultural exports, it's been to other regions of the world. So it's much broader than it used to be. We've moved away from the Europeans as our primary export partners, and so that diversity has helped to offset the possibility that there would be a major issue there. And obviously, parts of Europe are undergoing great stress, kind of the core of Europe, maybe not as much, with Germany kind of showing some better numbers in terms of their economic growth than expected. But certainly there is a lot of concern, and it will be continued to be monitored, though hopefully it would not have a huge impact.
Are you tracking, let's say, corn and bean producers worldwide that we compete with as far as their land prices? Are you seeing the same changes there?
I haven't paid close attention to land prices elsewhere, but my feel is that yes, land prices have been growing. If you look at places like Ukraine, some of the investors have moved in from the Western countries and have started buying up big tracts of land there, and so you do start to see areas where productivity had been very low, and now new technology and new ideas are being put into place to be able to exploit that, and to you've started to see some big increases in output of grains in particular from some regions like that.
Do you have any data on, you read about funds going in and buying tracts of land and then hiring a management company? What percentage of farmland transactions are occurring in that sector versus farmers buying other farmers' land?
I don't have a good number on the amount, but our survey indicates that it hasn't been growing. Farmers have been, in the Midwest anyway, more interested in getting that land, so that when there's a bidding process going on, farmers end up usually winning the bid. And then maybe there's a couple of farmers that are neighbors even trying to win it at the end, because it's that kind of open nature. What the investors often are doing is kind of going for ground that isn't as premium, that it doesn't make it to bid as much, but they're working together kind of more behind the scenes. And so you do hear some deals going on where they'll buy ground that's not as good, that they can put some money in to do tiling or other kinds of upgrades that then they can get the returns that they would want out of it. And so there's, maybe a third, somewhere in there, would be the kinds of things that you might expect the investors to be involved with.
Agriculture or land, real estate in general, and interest rates have a close relationship, in my opinion. What will interest rates have to do to create a difficult situation as far as the value of ag land? Is it going to have to double? Is it going to have to go up by 20%? And then the real question, when's that going to happen?
Yeah, it varies a lot. When I was mentioning the conference we had last year on rising farmland values, we had Brent Gloy from Purdue University there, and you can find on our website his presentation. It had some charts where where he was putting together interest rate and those cap rate idea in terms of capitalization into land values, and how the relationships with cash rents were. And definitely when you think about a doubling in interest rates, that would start to get them up to a level that would be much more challenging to maintain increases, but exactly at what point it gets through there, I don't know. It's kind of one of those research topics that's hanging out there, and the Federal Reserve Bank of Kansas City has had some research out on that too. So there's definitely a lot of uncertainty around that, and in a couple of years, we'll probably be to the point where we have interest rates rising again. So it looks like not imminently, but certainly on the horizon.
All right, thank you so much, David, for your great presentation. All right, lunch will start at 12:30. We'll leave this room for the hotel staff to set up the table for us. Please either take your belongings with you, or you can put your stuff on the chair and shovel the chair under the table, because we don't want the water to be spilled on your stuff, okay? So we will see you in 15 minutes. So